My favorite is being able to buy a deal for no money down. You completely de-risk the acquisition. So the way that this is done typically is you pay the target company in a combination of outside debt that you raise, and then either earn out or seller note, right?
Welcome to Frank Growth. I'm Jason Shafton. I run the growth consulting firm Winston Francois. Around here, we tell the truth about growing, the good, the bad, and the can't say it out loud ugly. Every episode, we get tactical with operators, investors, and builders about what works, what breaks, and what to do next. No fluff, no vanity metrics, and no hustle theater, just signal. This is Frank Growth, so let's get into it. Our guest today is Trevor Houghton. He is an incredible builder and operator who's worked in private equity and done a ton of work in corp dev, mergers and acquisitions, and acquiring and assembling interesting deals to create new businesses while also being an operator himself. He actually acquired a business, and we're going to get to hear from him about the process of doing what's called inorganic acquisition. We talk a lot on this show about organic acquisition, the traditional growth marketing. Okay, we're building a new product or service and we're going to launch it, and then we're going to grow it by advertising it and creating product-led growth or sales-led growth motion. Trevor knows all about the other side of growing, which is we're going to put these companies together, and that's going to be 1 + 1 = 3, hopefully. Trevor, welcome.
Great to be here, Jason. Thanks for having me.
Trevor, what's the one thing startups in non-tech sectors overlook when pursuing acquisitions for inorganic growth?
Yeah, I think when pursuing acquisitions, founders often think about the day one conversation as, hey, I want to acquire you, right? But oftentimes the best acquisitions are coming out of years of deepening partnership, right? And so the best thing I think that you can do, whether you want to acquire another business or be acquired as a founder, is to begin planting seeds for what those relationships could look like months or even years in advance, right? If you think that your most natural acquirer or even acquisition target could represent a go-to-market partner, then that's a great way to form a commercial partnership ahead of an acquisition. That kind of lets you understand what it's like to work with that business or understand what it's like to go to market side by side. And that allows you to have a much better understanding of what a successful acquisition and integration might look like over time.
So when you're looking at potential targets, how do you identify those based on like the core strengths of the business that's looking to acquire another business? Are there like quick litmus tests that you run? Like what's the process there?
Yeah, I think one of the things that you got to be very mindful of doing is either, but not both, of extending the customers that you serve or extending the capabilities that you have, right? And I say either, not both. You shouldn't make an acquisition that represents a new offering to a new set of customers. Yeah, so it's kind of like a 2 by 2 matrix,
Yeah,
right?
makes
You have
sense.
customers and you have capabilities, and existing is great, right? That one works really well. Existing customers, new capabilities, that can work if you know that the extension is natural. Existing capability to a new set of customers also works. What doesn't work is new capability to new set of customers.
Got it. When speed is really important, how do you zero in quickly on the right targets to get the max impact?
You should know your customers really well, right? If you don't already know what your customers are using, that your existing customers are using, that sits beside your solution, then you're kind of already behind the 8 ball.
Yeah.
Typically, you're going to want to pick the best in class solution, right? So a number one or a number two, especially in software markets, is usually going to capture all the profits, right? So
Yep.
find what your existing customers are using, find what is the number one or number two solution in that market, and identify it as a high priority acquisition.
All right, let's zoom out, Trevor, and talk about like the right strategy for inorganic acquisition. How do you think about approaching this area, as really a guy with a ton of corp dev experience? how would you educate somebody who's like, I don't know where to start and I don't know how to build a plan around going and buying and acquiring and inorganically growing my business?
Yeah, it's a great question. So when you approach anything as a leader of business, you got to think about what is your objective, right? And inorganic should match the company goals. In general, as a leader of your business, your objective is to increase the value of the business.
Hmm.
But enterprise value is typically determined with your valuation multiples, right? So now we have two components to determine, and it really comes down to that. We have two components to grow our enterprise value.
Mhm.
We can grow earnings, or we can grow the valuation multiple, right? So,
Yep.
on the growing earnings side of the ledger, right, we have a couple different things that we can do with acquisitions. We can grow revenue. So on earnings, right,
Yep.
if you want to increase your earnings, you either increase your revenue or you cut your costs,
Yep.
right?
What is the most critical integration milestone or step from your perspective to make sure that after the deal is closed, that the acquisition itself is actually successful?
So the most important thing to do is to make sure you don't hit day one without a plan, right? So you want to understand exactly how these companies are going to integrate. You should be thinking about that at the very earliest part of an acquisition process. And so the biggest mistake that you can make is not having a plan from day one.
Give me a cultural pitfall that you see most when folks are trying to roll up companies. You know, bring a bunch of companies together. What's the thing to watch out for across cultures?
I'll say something that might be a little bit contrarian. When you decide to keep cultures independent of one another, it appears to be a good idea from the outside looking in. Hey, we want to have different cultures and let everybody be their own separate thing. To me, that just creates an oil and vinegar situation. So you got to integrate cultures early. You got to take the best of both companies and ensure that everybody feels that the good things are maintained.
Yep.
But I think it's a bad idea to have kind of two independent organizations that are meant to be collaborating with one another.
Yeah.
My favorite is being able to buy a deal for no money down. You completely de-risk the acquisition. So let's take an example. I am a company with 10 million of EBITDA and I want to acquire a company with 5 million of EBITDA. Maybe I pay $20 million for that company. Because the combined company is going to have 15 million of EBITDA, I can easily borrow 10 million from a bank and tell the seller, I'm going to pay you 10 million down and I'm going to pay you 10 million in 2 years. And that's something that if you acquire the $5 million EBITDA business in 2 years, that will have generated $10 million of cash flow for you to then pay the seller of the business. And you've just acquired $5 million of EBITDA without paying a dollar.
For folks that are eyeing their first major acquisition and they're really trying to supercharge their growth, what is your headline advice? What's the one thing that they should take away?
My headline advice would be don't stop at the first, because once you have done an acquisition, you've actually built an acquisition engine. Don't take that machine and stick it in the closet and never do it again. If you're going to create a machine to do one acquisition, why not repurpose that machine and do many acquisitions?
Trevor, this was super helpful for anybody that is thinking about growing their business in the non-organic way. This inorganic growth was super practical and tactical advice, and you broke down the way that you think about it from years of experience of doing it. So for folks that are looking to connect with you and learn more, where can they find you online, and anything that you want to offer to the Frank Growth listeners today if they're interested in supporting whatever you've got going on?
Sure. I'm on LinkedIn. You can find me at Trevor Houghton. I'm CEO of Past Galleries. I do have a passion for helping entrepreneurs, especially ones that are approaching their first exit. I have, I don't even want to call it a side business, but just something that I do for fun. I counsel entrepreneurs on their exit. I've worked with 3 founders who have exited their business in the last year. And if you're exiting, then reach out to me and maybe I can provide some practical advice.
Amazing. So they can find you on LinkedIn. They shoot you a LinkedIn message, and they're looking to exit. Maybe they can get some of the classic Trevor advice.
Yeah, happy to have a call anytime. It's what I love to do.
Amazing. Well, thank you for being on Frank Growth, and this was a masterclass in inorganic growth.
Thanks, Jason. Happy to be here.
That was a masterclass in inorganic acquisition with Trevor Houghton. Here are 3 truths from our conversation with Trevor to make acquisition deals actually work. 1, the best acquisitions start as partnerships. date before you marry. 2, pick one vector, new capability or new market, not both. 3, day zero integration plan is a non-negotiable. That's Frank Growth. If this gave you something you can use this week, follow the show and share it with one operator who needs it. I'm Jason Shafton from Winston Francois. We help companies build sustainable, repeatable growth with a proven operating system. Show notes and takeaways are in the description. Connect with Trevor and see if he can help you on your next deal. Be frank and keep growing.